All right.
We ready to go, Matt?
Yes, we are. All set.
Great. Good afternoon, everyone. My name is Stephen Abernathy, and I, along with my co-host, Matthew Daly, will be your hosts today for the May 2025 First Friday meeting. In this meeting, we're going to focus our discussion on the allocations within the all-weather portfolio. As we've said many times in each presentation over the last, 12 months at least, the public markets are priced for perfection. Speculation continues to be abundant, as we've seen in the last 2 weeks specifically. And the policy emanating from the administration is changing rapidly. This really is a recipe for volatility, and it's the reason each of you or each of us on the phone here has a very large position in 4 and 5% Treasury bills. So today, our prepared comments are going to be recorded, as other families who can't attend have asked us for the recording, and we're going to try to keep our comments as close to 40 minutes long or less, leaving plenty of time for some comments or for some questions, because there may very well be some. If questions arise from the comment of today's presentation, please either send the questions along by typing the question into the chat box at the bottom of the screen, if you can, or write it down and just click the button that raises your hand at the end of the prepared remarks, and we'll bring you into the call. Our as you know, I said last time that our intent was always to make this monthly presentation really a give and take, a town hall type of event, because we realize the comments that we make may create questions or commentary that is different from our beliefs. The primary intent of the meeting each month is to ensure that everyone's questions are answered, and that we have sort of a clean slate going into the next month. And again, we really do encourage you to ask questions if something comes up, because your questions are valid and they're probably shared by others. One final note: mute your device and see if you can keep it on mute unless you have a question that needs to be asked, as background noise is audible and it distracts the rest of the participants. And as I said last time, if you haven't been to our website lately, please consider visiting. There's a wealth of information and it's helpful. So let me turn this over to Matt Daly, who's going to oversee today's presentation and get us started. Matt?
All right. Thank you, Stephen. Okay, so we're excited to have you with us as we navigate the current landscape and outlook for the markets and discuss how our investment strategies are designed to respond to a range of economic scenarios. In today's session, we'll begin by sharing our base case outlook for both the stock and bond markets, what we expect for the foreseeable future based on current data and trends. We'll then explore how our investments are positioned to react under various economic conditions, including downturns, periods of stability, and upturns. We'll also discuss how portfolios are expected to respond to changes in interest rates and inflation, as well as to major geopolitical events. Whether those are periods of conflict or peace, we'll touch on the important question of political leadership, specifically whether the current administration has the conviction and ability to maintain its agenda during times of economic stress, such as a recession or a significant market downturn. We will give an update on tariffs building off the sizable portion of last month's meeting we spent talking about it. And finally, we will address two industries we anticipate will see huge growth in the future, regardless of the market. Our goal today is to provide you with clear, actionable insights and to answer your questions about investments in an ever-changing world. With that, let's dive in and begin with our outlook. Stephen?
All right, thanks, Matt. Yeah, that's really a full agenda of topics to try to cover today, and I'm not sure we're going to get to all of them. So let's get started with the first topic, and that is what is the all-weather portfolio, and why is this type of investment structure one of the most valuable alternatives available to get us through this volatile period ahead? You know, why do we feel so strongly about having an all-weather portfolio during this period? When investing, it's important mathematically to avoid losing money. I think everyone knows that, but I don't know whether you've really had a chance to sit down and think about how detrimental losing money really is. You know, while this is true, of course, there are always going to be periods where money is lost because the future is just unknowable and things are changing, and it's impossible to stay on the right side of every future event coming down the line. So as the world changes, sometimes it changes in your favor and sometimes it changes against you. The important objective is to lose as little as possible when the future goes against you, because the mathematical effects of compounding. And let me just give you a quick example that many of you have already heard a million times, but it's good to remember it. You know, if you start out with $100 to invest and you lose a meager 25% of that money, it takes 37% of a gain to get you back to even. So lose 7% to get back to even. If you lose 50%, so your $100 investment goes down to $50, it now takes you 100% to get back to even. So just think about the dynamics of what's happening. Making 37% on your money is difficult, takes several years probably, but making 100% can take you a decade. This is why avoiding investment losses is incredibly important. And I'm sure all of you have seen these comparisons before. My point is not to bore you with repetition. My point is to remind you that losing money is not just heartbreaking. It's mathematically challenging and mentally disturbing. And if you're in a position like most of us on this call who are not interested in going back to work, you know, for 60 hours a week in remaking our wealth, there's less time available to make back what you've lost. So this is where an all-weather portfolio comes into play. By the way, we don't have any bias in this type of portfolio. We just think it fits with most family office investors when the macroeconomic environment is hostile at worst and unfriendly at best. All of us know the value of patience in our lifetimes. And when you remember the well-worded topic from Warren Buffett, who's, by the way, he's hosting his annual meeting tomorrow. By the way, if you have a chance, you might want to tune into it. There's usually some really interesting topics. He reminds us in the baseball analogy he likes to use that when investing when you are the batter, when investing, you can look at as many pitches as you'd like. When you're playing baseball, you can't. They call balls and strikes, but it's not like that when you're investing. The world of investment does not call balls and strikes. The importance of this is that you can pull the investment trigger when you find an investment opportunity that offers an advantage to you as the investor. Just remember this. It's an incredibly important concept, and no one on this call is under the pressure that that says you have to be invested fully at all times and you have to be chasing or outperforming the market. These are the wrong times to be doing that. So I think having patience and understanding what's going on, or I guess having patience and avoiding the Kentucky Derby-like narratives from the talking heads on television, I think it's valuable, especially when the market is as overvalued as it is today. So as we've said for almost 2 years now on almost every First Friday presentation, the public investment subset of opportunities, along with the vast majority of private opportunities we have access to, they're all overvalued. The current market is the equivalent of, in our view, of a bad pitch. And as intelligent investors, you must learn not to swing at a bad pitch, not because it's absolutely a losing investment, because sometimes you can hit a bad pitch, but it's because the odds are against you. And if you play the game long enough, and investing is a very long-term game, you want to wait for investments in which the odds are in your favor. You want to wait for that fat pitch. It's often what separates world-class successful investors from amateurs who are destined to experience some very, very expensive education on why patience matters and why it makes sense to wait for the attractive pitch of an investment with the odds in your favor, as opposed to chasing a pitch where everything has to go right for the investment to work in your favor. So this slide describes our version of an all-weather portfolio. It's all-weather because it's not dependent on appreciation to provide a tolerable return or even a reasonable return. However, if appreciation does occur, the portfolio will participate. If the economy continues to decline, the portfolio is both less risky than the average public company and higher quality, meaning it's likely to decrease less in value in a recessionary environment and bounce back sooner when an economy emerges from the downturn, which it will. On this side, you'll see the basic description of each asset class, the left-hand column, obviously. You'll also see the approximate allocation to each asset class, along with the dividend or income yield coming from the asset. The goal of the all-weather portfolio is to generate enough income to deliver a tolerable return while declining significantly less than the market if we enter a recession, which is our base case. So this portfolio is incredibly well diversified. It is, as you can see, there are several anomalies, or there's several interesting things. Look at the dividend yield of the non-U.S. markets relative to the U.S. markets. They're significant. Also, you can look at the dividend yield on the portfolio as a whole, which we didn't list because it changes. By the time I finished doing it yesterday, or updating it yesterday, it had changed again this morning. So we just took it off. It's about 5% for the portfolio as a whole, which most of us have agreed, if we didn't do anything but make 5 or 6% a year on our portfolio, we could probably live just fine, or better than fine. So let me stop right there and check with Matt. Matt, any comments on that, or questions, or is there anything in this that makes you scratch your head and ask how or why?
No comments or questions from attendees, and I thought if I do say, I thought it was a clear explanation. I think we can continue along.
Okay. All right. So why the all-weather portfolio? We believe that this strategy attempts to be, or to offer, a heads you win, tails you don't lose strategy. We don't know what lies ahead, clearly. The investment choices are so expensive that they make little sense relative to the risk of downside, which is likely over the next couple of years or two, or maybe 4 or 5 years, as we'll get into. We believe those investors who are counting on their investment portfolio's appreciation, we think they're going to be disappointed. We've moved up in quality. We've moved into value-based securities for downside protection. Our securities are about 3 times closer to book value than the marketplaces. And we've structured the portfolio to generate pretty close to a 5% or so yield in dividends, which is largely tax advantaged for most of the high income people on this call. So let me stop there just for a second and find out, Matt, does anything in that description give you pause or, you know, sort of generate a question from your standpoint?
No, that was clear.
Okay. All right. So let's go through a summarized stress test of the all-weather portfolio. So this slide reminds us as investors to make a few decisions before allocating your investment portfolio. So you need to understand whether you are in an environment that allows you to be offensive, meaning you're looking for attractive returns because the market is cheap, or defensive because the market is expensive. And you're trying to maintain your capital first and then be intelligent or make intelligent decisions second. First, I think we're almost all in agreement that the investment values are not attractive enough for us to be offensive in looking for typical or higher than typical returns. So my statement to you about that is it's not the right time to try to be heroic and look for returns that are over and above historical returns, which are about sort of 6% a year, 3% with inflation. So kind of a total of 9% normal total return. Or on the other hand, is the investment universe overvalued, and are we in a subpar risk to reward ratio? So as most of you know, we believe the current market valuation remains overvalued. We believe earnings expectations, which have supported this overvalued stock market, they're much too high. The combination of, we think, an earnings downturn combined with an overvalued market in the first place supports a really defensive position for us. So it brings us to our next decision, which is, do we have enough confidence in our macroeconomic view to take a definitive directional position in the market? Meaning, are things cheap enough for us to really, how would I say, evidence our optimism for a directional position in the market? And the answer to that is almost always no. You know, and the reason for that, at least on our standpoint, is we can't see the future. Diversification is the most intelligent stance to take today. So just make sure that either way, if you have again, the more you know, the less you should diversify, and the less you know, the more you should diversify. And finally, as always, when the future is too hard to call, just like Mr. Buffett, we have a box on our desk that is, we call it the too hard to call box. It allows us to remain safe, exhibit patience, while we collect more information and wait for the marketplace that offers us an advantage. So right now, as we stand, we have almost 50% of our assets in assets that aren't going to be inhibited if we go into a bear or a really difficult market environment or economy, or a geopolitical nightmare. Let me stop there and check with Matt to find out if he has any contra thoughts on that.
Not contra thoughts, but I am curious, putting you on the spot a little, is what I think I know the answer, but what would be better, I guess, if if companies are widely overvalued, and we've been talking about this for a few months. I think in December we dedicated quite a bit of time to it, but they either have to adjust and be valued correctly, or you had said last time we have to wait 10 years for the current valuation to catch up with the price. Um, what's better? I mean, I guess if you're not, if as long as you're not on
We
the
lost
dance
you.
floor when the music stops, you would rather it correct sooner than later, so that you know valuations get in line and money can be made again more readily. Is that right?
It is right, Matt. The challenge is that, so everything is based on earnings. And while the talking heads, they continue to try to make this market, to describe the market like it's the Kentucky Derby. Somebody's ahead today, somebody's earnings tomorrow, and it's moment by moment, which is just absolutely ridiculous. The bottom line is that the periods you guys have seen before, we're going to use it again because it's incredibly relative to our current market environment. When things get overvalued, supported by a narrative that continues to say that the world is changing and it's changing for the better and everything is going to be wonderful, things get so overvalued and speculation is so rampant that it takes a good while for these corrections to take place. And what happens is you enter a period of 5 or 10 years where the volatility down is bone shattering, and then the volatility up gives people the feeling that everything's okay, only to be followed by more downturns. And this goes on for 5 or 10, or in the chart, you're going to see sometimes it goes on for 20 years. I think that we're closer to that kind of period than not. And the reason for that is our debt load. We don't have enough money. We don't have enough free cash flow to invest in things, in activities like rebuilding our highway system or rebuilding our grid. It takes money to do these things, and indebted countries, as outlined in the book, it's different this time by Rogoff, and by Rogoff is good enough. It's just quite evident. I mean, this has been happening for 1,500 years. So the bottom line of that is, or to answer your question, Matt, it feels like to me that, just like you said, either we have to go through a significant correction or we have to tread water with, I think, unfortunately, with a lot of volatility going on, going nowhere for years. And by the way, it's already started. In 2021, the NASDAQ 1,000 was at about the same level it is today. So we've gone nowhere for the NASDAQ 1,000 in the last 4 years. So I think it started in the smaller cap companies. I think we're going to find out that it's going to continue on with the larger companies. Let's move on. Here's where we try our best to sort of summarize the investment stance, which makes most sense to us, at least. Firstly, we should have a view on our U.S. and global economy, and our view is that the combination of the U.S. government cutting back on spending 6 to 7% of deficit spending on GDP on stimulus categorically puts a 2.5% GDP into a recession. So just again, I'm just asking you to think about third grade math. If the administration is spending 6.5% that it doesn't have, obviously, to prop up our economy, and we're only growing at 2.5%, it really does suggest that we're shrinking at 3 or 4% a year. And our last GDP number shows that we are in a negative position with GDP, and I think that's going to continue to get worse and worse. As we've said time and time again on our monthly presentations, a country, as I said, spending 6.5% more than it makes, because we can print money in an economy growing at 2.5% will be in a recession without deficit spending. The current administration says they're going to cut the spending, yet so do almost all administrations entering the White House. I mean, it's a campaign trail constant. However, there may be a bit more reality to this claim in this administration than other claims. And I'm not trying to be political in any way, shape, or form. Either way, the U.S. economy is slowing. Whether it slows because our administration does cut back, or whether it's just because corporations don't see the demand. We believe the chances of recession have increased since the beginning of 2025. If we enter a recession, earnings will decline more than most expect. Stock prices will follow as earnings, as we just, agreed or said, earnings support the logic defining a company's valuation. If we avoid a recession, on the other hand, and the economy enters a period of economic upturn, earnings will likely be as Wall Street expects. And our stock market will likely avoid a significant downturn. Yet the upside is already priced into the market's current valuation. That's what I was trying to describe in this up and down marketplace where things just they go nowhere for years and decades. So, as we've said for months, the good economy is already priced into the market. Interest rates, on the other hand, it's too hard to call today. If we go into an economic downturn, we believe the U.S. Federal Reserve will lower rates and use its old playbook for making sure there's adequate liquidity in the market. However, the administration's goal of creating a more even playing field of trade and tariffs adds a level of difficulty in sort of trying to see the future, and it really does present a significant problem in determining what risks lie ahead. Either way, we believe our most well-researched guess is that the mercantilism era has started. It's more likely than not to continue. The global alliances are going to bifurcate, and there will be more manufacturing at home for almost every block of countries that are friendly. This is going to increase prices as, at least in the United States, as our labor in the United States is among the most expensive in the world. So what's our base case? As investors, we should expect one of two outcomes, as we just went over a little while ago with you. Expectations are higher than they should be, and markets are overvalued. Outcome A is as Matt described. a period of 5 or 10 years in which our stock market has violent ups and downs, each with its own narrative. In bad times, the world is ending, and in good times, there's nowhere to go but up. The talking heads have a great time on television, and those people who sit there and listen to it are going to be whipsawed. As showed in this slide on the screen, these periods of stagnation in market prices happen way more frequently than most people think, and they last for longer than most expect. Outcome B, on the other hand, would include a strong sell-off in the market prices to significantly below fair value. What I'm trying to describe is when things start turning negative and the narrative turns against you, prices almost always overshoot on the downside, just like they overshoot on the upside. And there's no telling how long they'll stay there, but they'll come back to reason at some point. The big fear on our standpoint, or from our perspective, is as U.S. debt increases the risks on almost every outcome. We're now paying approximately $1 trillion in interest payments alone each year. That's ridiculous. And in almost any scenario, it's likely that interest rate levels set by the U.S. government, if they have their way, are going to be lower. They would like to have lower interest rates because it helps them repay their debt. Matt, what do you have to say about any of these things, or does any of that make sense, or are there other ideas or the other ways that things could kind of evolve?
Go back, if you don't mind, just to a quick point, just to add a little something on the tariffs as a leverage mechanism that you mentioned. Just good to note, we also have leverage in a variety of other areas, including, in most noteworthy, probably defense, especially with a lot of the countries we're arguing with over tariffs. We have, most of them are reliant upon us for their primary defense. And also, to kind of merge two topics together on the AI piece as well, technological development. Europe, I don't know if anybody of us can name the biggest AI developers in Europe or other key technologies, pharmaceuticals, et cetera. They rely upon us for that as well. So that's another leverage point. I'm just trying to, I think like last month, trying to illustrate the picture that other countries, the European Union especially, like to pretend to be independent, but they're not. And most countries in this hemisphere, at least, and in Western Europe especially, are completely dependent upon the United States for many things, including survival.
You co-wrote a paper not too long ago about the One Belt, One Road initiative that China has been secretly, not secretly, but under the radar for the last 25 years. And it's funny because I can't help but drawing a parallel that the United States has been having its own One Belt, One Road initiative with respect to defense of all of our friendly nations, all of the democratic nations. I mean, Europe is, as you said, completely, and utterly defenseless. Not only are they defenseless militarily, they don't have an ocean to protect them. They don't have, it is a shame that all of us have been asleep at the wheel for so long that we allowed our quest for cheaper, faster, better, without trying to do it at home. and each country needs to figure out that they need to go through the pain of increasing their ability to manufacture and make things and deliver things economically, or pay up for it, or lower their standard of living. I mean, there's pain coming. It is, you and I have often talked about the likelihood of an operation if you have tennis elbow, or an operation if you have a bad knee. I mean, you have to figure out whether you want to go through the pain of the operation and the physical therapy or not. I really think that your insights, Matt, have helped me kind of build a straw man going forward. So yeah, I agree with you deeply. Okay. So Matt, I'm going to turn some of these things over to you. Do you have any comments on our administrative policies that we haven't talked about, or the tariffs? And then I have a couple of things to say that I think may be really uplifting to end this presentation. What do you think?
No, I don't have anything else on the tariffs. I think we covered it a lot last month, and I just wanted to add those extra points. But I think it's still in line with what we said, or good or bad. It could be good or bad last month, and I think we haven't seen the results yet. A month has gone by, but we haven't seen whether it's going to be good or bad yet. But it seems to be some movement. It's not widely publicized, and I guess those negotiations happen behind the scenes for the most part, and then they get announced. But I've heard some murmurs that people are coming to the table, but it still remains to be seen whether the leverage tactic is going to work. Or I don't. Just the one question I have is the design of this actually to implement tariffs? Because I know it's been thrown out there, and um, it's a historical example of not having income tax in the United States, and having everything funded with tariffs. I've heard that. The thing is, with this administration, we saw it last time, there's a lot of things said. It's hard to keep track of what is real and what's just something to get somebody to think something else, or, it's hard to follow. Um, but anyway, I'm curious whether the true goal is total free trade, or if it'll just be reciprocal tariffs, and either, one way and the other. Um, because that makes a difference. And I don't know which scenario is necessarily better, but it certainly is two very different situations.
I have some really strong comments on this, and they're not political at all. As most of you know, I was not a Trump supporter, and I haven't been until he put his team together. But I think I am I'm a physically thoughtful person, and I realize that we can't spend more than we make, guys. I even think this 333 that Bessent is throwing around is a little bit too reckless. I just don't think we can spend more than we're making. And, with the amount of debt we have to spend less than we're making, and we have to start paying back our debt. But let's just deal with this slide real quickly so we can get on here. So here's what's happening. The administrative policy has increased the likelihood of a recession, and I want to bring that up only because a recession with this amount of debt it could have domino effects, and that's scary. I mean, it's actually really scary. While the administrative policy could change rather quickly, and it has, the policy will likely continue to support lower economic growth over the short term in an effort to A, decrease trade imbalances, making when goods and services become more expensive because tariffs are enacted, it slows economic growth. That's A. B, I think, we're going to increase tariffs with the goal of reciprocity. I don't believe care about anything other than just being equal. I really think that's right. And C, there's going to be an increased self-reliance on in the U.S. and its neighbors to redirect internal economic initiatives that we can manufacture critical goods and services that are necessary for the stability of every one of the democratic economies. Tariffs in any type of friction that's added to the cost of a good or service, it's bad. It's probably bad. Tariffs, and they know this. Avoiding any attempt to create a world or create a political stance, which we want to avoid at all costs, would remind everyone on this call that tariffs, by the way, they're both good and bad. Tariffs are used to create a negotiation. I think you were alluding to, Matt. Tariffs are used to create a negotiation advantage or to correct a disadvantage. As we stated in our last First Friday meeting in April, it's clear to us that the U.S. is the strongest country in the world. This is what you were saying, Matt, and with the most significant level of consumers in the world. So we're the strongest country militarily in the world, and we have consumers that will spend 5 times more than they make every year. So we're a honeypot. Despite these basic facts, and despite the fact that the United States has been responsible for the security of the Western world for over 50 years now, we collect, just remember this, we collect $80 billion per year in tariff money, and we pay over $600 billion. It could be over $1 trillion. So the reason I'm saying that is because the numbers get a little bit foggy after you get to $600 billion. So we're paying roughly 8 to 10 times the amount of tariffs, at least, that we're collecting, despite being the strongest country in the world and despite having consumers that really are the jackpot for most export nations. So we're not being political when we say that relationship makes no sense to us. And I really believe the rest of the world will agree, and that something is going to come of this. And those who were throwing rotten apples at the administration are going to become, they're going to have to be quiet. I hope that happens. If it doesn't happen, it very well could drive us to a geopolitical conflagration, and that's what I'm hoping we're going to avoid. So we believe that tariffs are a negotiating tactic, and they're going to reverse themselves as our trading partners come to their senses and start to play a bit more fairly. Keep in mind that tariffs are generally a negative, yet, as we say on the slide right here, tariffs are generally, I guess you'd say, they're defined by how long they're in place and how high they go. So, Matt, would you say that you think that there's a likelihood that there's a reasonable degree of certainty that the tariffs recently imposed by the administration are meant to be reciprocal? I mean, do you think if we could get everybody to go to zero, would the current administration be happy?
That's what I'm asking. I think there's a non-zero chance that the goal is global free trade, um, or at least as it relates to the United States. I don't. That's what I don't know if that's the aim or if it's just to have reciprocal tariffs. The thing is, it's a little tricky because we're always going to import, or we're usually going to import more than we export because we're just bigger than most, 80 to 90% of countries, and we're richer. So it, that's the tricky part too, because it's not going to be an even dollar amount, but the percentage at least should be the same. whether that's zero or if it's just an equal number, I've not seen any indication one way or the other, but I think both are possibilities.
Got it. Okay. Um, okay. So let's move on to this last topic because I think it's important enough for everybody on the call to think about these two very high probability events that the market is missing. First is that AI or artificial intelligence, machine learning, moving to be more advanced and more advanced is really having an outsized effect on our healthcare market. And Matt and I were talking earlier I guess it was yesterday, and he brought up the fact that quantum computing, which is the next level up, aimed at healthcare, there are so many things that are going to take place. Healthcare, I just want to make sure that you know that healthcare is leveraged towards a one-to-many outcome, meaning you have a molecule, it has activity at receptor sites on cells, and you need to find the target or the receptor site on the cells, and you have 50 or 100 different targets. AI is excellent at decreasing the time of finding the best cell site and decreasing the toxicity. They can help you make decisions like that really well. Healthcare is going to be a monster beneficiary of AI. The second point I wanted to go over with you, just to make sure you don't forget, last month we talked about the utility conference, which wasn't a sleeper, which is unusual. What we found out was the utility world is expecting to have demand for electricity that is 3 or 4 times its normal demand. The reason I'm bringing this up is twofold. Number one, it's absolutely an incremental positive towards the natural gas industry. Please understand that. Transporters of natural gas from point A to point B are going to be benefited. Producers and drillers that are able to produce natural gas are going to be benefited. The second thing is that it is impossible for our grid to handle the amount of electricity that we need transported from point A to point B. So either we're going to have the electricity generating plants built at the well sites, or we're going to have a huge new grid infrastructure built. My bet is, and it's a really advantaged bet, is that the grid is going to have to be reformulated, and there's going to be a huge demand for infrastructure over the course of the next 5 or 10 years until we can build our grid and make it impenetrable. Don't forget, if we go down, water goes away, electricity goes away. I don't think that would be, I know New York City, that would be the end of me and my family. That would be sure. But the bottom line is grid is going to be, I think, is going to be a natural target of rebuilding. With that said, anything else, Matt? Any questions come up or any topics that you think we didn't talk about that were important?
No, just one small thing to add to the energy, because we talked a lot about geopolitical events and like a bifurcation
Oh
of
yeah.
global systems. I think that benefits our domestic energy industry and probably opens up new or increasing markets for us in terms of providing that energy, especially Europe. If something happens in the Middle East or with Russia or China, even. That bifurcation supports an potential increased energy demand internationally for our production.
I totally agree with you. And over the course of the next month, I've got scheduled a 2 or 3 day private equity tour. And the reason I bring that up is that, private equity tends to be on the cutting edge of these things, sometimes on the bleeding edge.
Mhm.
And then on the 22nd, there's a meeting, there's a nuclear energy meeting that with some pretty high level people that we're attending. So again, I think natural gas is the bridge to nuclear, and nuclear is the bridge to eventually renewable resources will probably become fungible. In the meanwhile, just keep your eyes on ideas that are supportive of grid rebuilding. And as far as the healthcare goes, the biotechnology sector is the most leveraged to this. And I've just put together a list of 12 companies that are in the biotechnology area that have incredible opportunities in front of them that are all selling for under their cash value. So you're talking about incredibly gifted and structured companies already out there with revenue, significant revenue, that are selling under cash. So this is going to change. We'll be back hopefully with more information on the next First Friday meeting. In the meanwhile, thank you for attending. Give us a call if you need anything. We'll look forward to hearing from you this next month. Bye now.